Hello, it's John Burford, and this is a brief introductory video on how I use Fibonacci to give me vital information on where to enter a trade when trading in the same direction as the prevailing trend. For instance, in a bull or a rising market, it's a good idea usually to be buying on a dip. So instead of guessing where to get in, Fibonacci can give you fairly precise entry points in advance. And that's one key reason why I like using Fibonacci. Now I'll present here just a couple of basic ideas so that you can use them right away in your own trading. I'll give some more advanced methods in a later video. Now, if you're interested in learning about Fibonacci, he was a mathematician in the 12th century. In fact, he was born almost 750 years ago, which makes it quite remarkable that we're still using his key insights into the growth and decay of natural systems. And that's what we're dealing with here, of course, in markets. It's a natural system. Okay, so what is Fibonacci? What do we mean by it? Well, it's really a series of percentage retracements from extreme points. In other words, from a top and from a low. It'll give you, in fact, the spread betting platform that you use. I'm sure we'll have one. Here's mine here. All the very hard work is done for us by the software. So we don't have to work out percentage levels by hand or anything like that. We just apply it to the market. Let's take this point here. I'm going to click on this low here, and I want to investigate. Let's get it. I must click on that, and I must investigate. Let's investigate this one here. There we go. That high there. I've just move that up so that that this is the high. Now this is a bull market, of course, and so we're looking for a dip. And in fact, here, if I can just give you a bit more room so you can see, there we go. So from this low here to this high here, we're looking for percentage retracements. This is the first one, which is the 23% level, and right away we see that the market did in fact come down to the 23% level retrace, found support, just a little overshoot here, and then resumed the upward trend. So that's how I use my Fibonacci tool. I select a significant low, which obviously is this one here, and if I'm trading in real time, say around here, I can say, right, well, that is the most recent significant high so far. Let's see what happens if I put my Fibonacci tool on. And as the market drops down, it hits a Fibonacci level, and you're waiting there a day or more in advance, and you could actually be placing your entry buy orders there. Now, I will say in practical terms, the market, of course, could have moved down to this point. Of course it could. It could have moved down to this point. But the essential point in trading, though, is to select a point, and in fact you may have other methods which will give you more clues as to which of these Fibonacci levels the market will actually turn around at. In this case, I don't have another one, so we're flying blind here with Fibonacci. So you could have actually been setting a resting buy order in here, and of course it would never be touched because the market went on. That's the vagaries of trading, of course. And in fact, you could be buying here. You would have been all right, of course, because the market moved up. But then what sometimes happens is the market moves up, then it moves down again, perhaps towards another Fibonacci level, and you'll be stopped out. Well, that's trading. There's no guarantees. But all I want to show you in this video is that very, very often retracements do stop at Fibonacci retracement levels. Okay, let's get rid of that. Let me choose another example from more recent trading. This is the very complex trading we've seen in the last month or two. The highs were made up here, 12,800, I had a big plunge down, of course, and of course a relief rally. It's very choppy, but let's see if we can find any Fibonacci retracement levels in here. Okay, here is the actual high. This is absolutely a significant low, so let's apply our Fibonacci tool to that. So there's the most, that's the earliest, I should say, the earliest pivot point, which is the high. Move it down here, and I'm anchoring it on this low here at the 0 line. It doesn't really matter. These numbers here are not that significant because if you look at a retracement from this point, then that certainly is a 23% retracement. But if you're looking at a retracement, counting it from this point, that's actually a 76% retracement line. But the important point is the placement of the lines. Now, I will say this, on my spread betting platform, they have been a bit naughty. They haven't actually put in the 76% line, which would lie up around here. Now, that's an oversight on their part. What I do in this case, if the market is getting up into this area here, I will actually work it out by hand and use my horizontal line tool, which I'll do now. I'll just show you briefly how I do it and then anchor it there. So I know it's a bit clumsy, but that's the best I can do with my platform here. Okay, let's get rid of that. So now we have a complicated rally. This rally did not stop at a recognized Fibonacci point, but this latest one, this is the latest high, did. There's a little overshoot with these two little tails, little pigtails. Now, that's a little giveaway, actually. If you're finding the market has rallied up to a recognized Fibonacci level, which is 50% is a very solid level, and if we find pigtails, in other words, a quick dart up and a quick zip back down again, this happened on both those days, then that's a pretty good indication that that's major resistance, and we should expect to see a dip from there. And in fact, we've got quite a substantial dip down to here. Okay, so we could be trading using this knowledge. We could be shorting here. In fact, if we believe the market has turned down, which I think it's pretty safe to say it has, because this is a big down swoop here, and this looks like a corrective sequence. All right, let me show you one more example. I'll pull up the US Treasury bonds. Now, the Treasury bonds, 30-year bonds, it's a future. This is the December future, and it's one I do trade quite often. I don't really cover it in the emails, and maybe I will later on. But it usually has a negative correlation with the Dow Jones. In other words, if the Dow Jones, the stock markets are rallying, normally that's bad for bonds. And that's certainly been the case in the recent past. Okay, this is a 30-minute chart, only going back to about a week or so. Here's the recent high. We've had a rally up to almost record. I should think they are. I haven't looked in the past, but 142 here is a very, very low yield. And the yield, by the way, on the bond is inversely proportional to the price. So the higher the price, the lower the yield of the bond. So these are record low interest rates, and that's for a 30-year bond. That's quite noteworthy. Okay, so let's see what happens if we start drawing Fibonacci retracements from this significant high here. We've had a plunge down here. So let's do this. We will just squeeze it up a bit so that I think it becomes a bit more apparent. There we go. So if this is our significant high, we click on it because that's the earliest point, and we go down to this significant low here. We see from this low we've rallied exactly to the 62% level. Don't know whether you can see that. I wonder if I can show you in more detail. There we go. That's a little bit better. Okay, to that level, the 62% level, and bounce back down. So that would be an excellent point to short. It actually made another rally up, but it actually exceeded this high here. But look at the pigtails, as I mentioned on the example of the Dow. 3 pigtails, which meant that every time the market tried to get up above it but was knocked back down 3 times, and you're out. Down she went. Okay, that's a pretty good illustration of how you can use these candlestick charts to give you some clues as to the direction of the market. Right, let's get rid of that. Now, the next significant move is this one here. But as you see, the market came down, but it did not, this low did not exceed this low here. So what we need to do is keep to our Fibonacci pivot points, the same ones as we had before. Let's see, it's a bit sticky. That's very sticky. I'm not able to close that gap up, I'm afraid. But anyway, I've got that point there, and we see the rally off here, just a little pigtail above the 62% area here. So obviously the market did not like this area here. Big, big resistance. A clue that the market was set for a fall. So there we go. The market is falling. Let's see if we can find any more Fibonacci retracements. Okay, here's quite a good one. This is interesting. We've dealt with that one. We've had a new plunge to a new low. Here's a bit of a rally. So up here, if you're trading in real time up here, you might consider that as a significant low. And where is the significant high that we can use? Well, I think that is the one. We've already bypassed that. That's the major one. This is the secondary one. So let's see what happens if we use that as our pivot point. And we've got our low down here. Sure enough, the rally crashed through the 23%, hit 38%. There again, some pigtails. I don't know if you can see that. I'll expand that for you. There we go. Some pigtails here, and a big down day, confirming that that was indeed solid resistance at the 38% level. Now, I will say this, with have you seen with these examples, with Fibonacci, you're not often going to get an exact hit on the line and then a total rebound off that line. You're more often than not going to see this sort of effect here. So if you're actually following the market in real time, which I know a lot of you are, you can be looking at the fine scale. I'm using the 30-minute chart here, and I wonder if I can pull up the 15-minute. There we go. You could be looking at this action here in real time, seeing what happens around this level here, this area here, especially with regard to the momentum. Now, I'll cover momentum and divergences in another video, but this is something that you need to keep an eye on when trading around Fibonacci levels to give you a clue as to whether the Fibonacci level will hold or will not hold. Okay, let's get rid of that. I think there's possibly one more example in here. Look at this action here. This is quite remarkable, isn't it? It's quite spiky, the Treasury bond market. Right, let's yeah, here's the high. Right, let's go back to the actual high here, the previous high. This is a significant low here, some very choppy action. I want to know how high this is likely to go. So let's get the Fibonacci tool working. That's my high. That's my low, just about there. And I'll squeeze this up. There we go. There we go. Right away, we see that we had a massive spike here. Then we had another rally, another pigtail above the, I think that's the 62% level, that's right. And then another chance at it, came back down. It really is bouncing along this level here. This actually is not a Fibonacci level, based upon those pivot points I've used. But if you're trading around here, you would get a pretty good idea that if this point was broken, you'd say that would be the end of it. And sure enough, we had a massive retreat off of this level here. Okay, I think that'll do it for now. I'll have some more advanced methods for you in another video. I hope you've enjoyed it and I hope you found it useful, and I'll see you in the next video.